Do you want to learn how the stock market works and why it's one of the most powerful ways to make your money work for you? Well, stick around because I'm your former Wall Street professional that has made this video for you. Because the stock market sounds complicated, like it's reserved for people in suits. But here's the truth. If you can understand how buying a slice of pizza works, you can understand the stock market. And once you really get it, something shifts. It stops feeling like gambling. It starts feeling like one of the smartest moves you can make with your money. So in this video, I'm going to break down everything you actually need to know before investing your very first dollar in a way that just makes sense. And before you know it, you'll realize how money can start working for you and not the other way around. Do me a favor and gently tap the like and subscribe button because I give the biggest life-changing tips to building your rich life here on this channel. So let's get into it. Let's first establish what the stock market actually is. The stock market is not a place. It's not Wall Street. It's not people yelling numbers anymore at each other on this trading floor. It's simply a marketplace where people buy and sell ownership in companies. That's it. When a company wants to spend money to grow, it actually only has two choices to add cash. One, it means to borrow money, which is what we call debt. Or two, they have to sell pieces of itself to the public. Those pieces, they're called stocks or shares. So when you buy a stock, you're not just putting money in the market, you are literally owning a small piece of a company. If that business grows, your piece becomes more valuable. If it struggles, your piece loses value. Simple. But you might ask, why do stock prices go up and some go down? This is where most people get confused. They look at charts and think, this is random. This is chaos. Well, it's not. Stock prices move based on supply and demand, but more importantly, expectations about the future. If investors believe a company will do well, more people want to buy. Prices go up. If confidence drops, or in other words, if investors believe a company will not do well, more people will want to sell and prices go down. But here's the part that changes everything. A stock price is not based on today. It's based on what people think will happen next in the future. That's why a company can announce record profits and sometimes the stock still drops because investors expected even more. Once you understand this, the market starts to feel a lot less random. There are only two ways stocks actually pay you. Number one, price appreciation. So if you buy a stock at $50, later it's worth $120, you sell, you keep the difference of $70. That is profit. Or number two, in dividends. Some companies will actually pay you just for holding the stock. It's like getting a small paycheck without selling anything. This is generally more applicable to investors that want to preserve their wealth. It really depends on what type of investing you feel comfortable with. Most beginners focus on growth and wait for the stock prices to go up. The more experienced investors often use a little bit of both. Again, there's no right or wrong answer, but just different styles of investing, whichever you feel most comfortable with to help you build your rich life. Now, you probably hear of many people saying to invest in broad markets index like the S&P 500. But do people even know what indexes are? Let me describe it to you in terms that are easy to understand. An index is just a scorecard for a group of companies. The S&P 500 tracks 500 of the biggest companies in the US. The Dow tracks 30 companies. The Nasdaq leans heavily into tech companies. But here's why this matters. You don't have to pick individual stocks. You can invest in the entire index. In other words, you own a piece of hundreds of companies. Your risk is spread out, or what some would call diversified. You grow with the overall market. This is exactly the strategy that many top investors, including myself, recommend for beginners. Not because it's exciting, because it's effective. It is simple and it works for anyone, whether they know how to invest or not. So if you're not sure how to pick stocks, investing in indexes like the S&P 500, which means you own a piece of the top 500 stocks in the US, will be the right strategy for you. This is where things get serious. Compound growth means you earn returns on top of your previous returns. So your money doesn't just grow, it actually starts to accelerate. Let's make that real. If you invest $10,000 at 10%, year one, your $10,000 is worth now $11,000. Year two, you continue to earn 10% now on $11,000. The extra growth compounds year after year after year. Now stretch that over decades. Starting early doesn't just help you, it changes everything, because in investing, time matters more than talent. Let's talk about the rookie mistakes that cost you years and years, and make sure you don't fall into these common traps. Years down the road, you'll thank me on this video, so do me a favor and tap that like button. Mistake number one. Mistake number one, people try to time the market, which means they think they know when to buy at its lowest price and sell at its highest. Truth is, nobody has a crystal ball. Nobody consistently gets this right. Not even expert, not pros, not your friends or online influencers that says that they called the crash. So what actually works? Staying invested. I said it earlier and I'll say it again. Timing matters more than talent. Stay invested. The second mistake that investors make is something we call panic selling. This is when stock markets drop because Trump tweeted something about tariffs or a war, and as a consequence, you sell your shares because you were panicking. Remember, markets go up and down. That's normal. But if you sell when things are down, that's how people lock in their losses. Think back to COVID in 2020 when stock markets tanked because no one could go outside. 9 months later, that stock market was back where it was before. Or even more recently when Trump imposed tariffs that caused stock markets to crash in the earlier half of 2025. Well, guess what? The stock markets recovered and even hit all-time highs by the end of the year. The market has always recovered. The question is whether you're still in there when it does. Mistake number three is what you commonly see on the internet, especially on degenerate places like the subreddit Wall Street Bets. And that is putting everything into one stock. This is not investing. That is guessing. Or some people would say gambling. Do not do this. If you are not a sophisticated investor working on Wall Street, diversification protects you from one bad decision that will wipe your portfolio out. The truth is, while you might read a lot of stories of investors making generational wealth because of one great stock guess, basically no investors will post when they've lost their life savings. Be real and stay invested. That is how Warren Buffett, the king of the stock market, became king. And the last mistake is to avoid waiting to invest until you feel ready. This one quietly hurts you the most because while you are trying to learn, time is passing. And time is the most valuable asset when it comes to investing and compounding your growth. Say it with me. Time matters more than talent. Get started now, even with a little bit, and make sure to consistently invest more, even if it's a little bit at a time. So you ask me, how do I actually start investing? Well, let me give you an easy 4-step plan to get started. Step 1, open an account. Start with a 401k if your job offers a match, or open a Roth IRA. Both of these have major tax advantages that will save you thousands of dollars in the long run. If you don't know what these are, go to your local bank and ask them about the 401k plans, and they will teach you what it is and open one for you at the same time. Step number 2, pick a simple index fund. Remember, picking stocks is not for beginners, and picking a broad index like the S&P 500 almost always outperforms stock market over a 10-year period. The S&P 500 is a fantastic choice given that it is an aggregate of 500 of the best companies on the market and does not come with annual fees. Step 3, automate that. Whether you start investing a lot or just tiny bits at a time, like $20 every month, automating monthly transfers to your investing account to invest in the S&P will take out the emotion out of the equation and make your life easy. From here, you set it and you forget it. You will thank me later in the future. And lastly, step number 4 is to not check your account daily. This is because the market is noisy in the short term, but powerful over time. All right, so let me remind you that the stock market is not a casino. It's not reserved for the wealthy, and most importantly, it is not too complicated for you. It is just a system. It rewards 3 things. Number 1, patience. Number 2, consistency. And 3, understanding the basics. You don't need to be an expert. You don't need perfect timing. You don't need to feel ready, because every great investor started exactly where you are right now with that very first dollar. The real question isn't, do I understand everything yet? It is, when am I going to start? And if this helped break things down in a way that finally makes sense, you'll probably want to watch this next video on how maxing out your investments in your 401k for 10 years can easily make you a millionaire, as well as this video on the tiny habits that get you ahead financially. And if you like this video, I'm trying to get to 10,000 subscribers, and I'd greatly appreciate it if you like and subscribe to this video. For now, see you next time.